Hello everyone, you're welcome back. Alright, so this is Dee SM, and this is the continuation of the series that we started last 2 weeks. Alright, last 2 weeks we were talking about basic market structure, while last week we were talking about advanced market structure, and I said this week we're going to be talking about understanding liquidity. Alright, so that is just why we are here. Alright, so basically, I wanted to say something before we continue. You know that it's one thing to get knowledge, it's another thing to put it into practice. You get what I'm saying? Meaning that there's no matter what I'm going to say today, if you do not put it to practice, you will not still get it. It won't hard anything. Are you getting me? Alright, because knowledge, unapplied knowledge is not skill. It is only a knowledge that is applied that is a skill. What I'm trying to say is that whatever it is that you're going to learn today, it might be something that you already know, it might be something that you do not know, it might be just something that you need to push yourself from where you are to another place. Alright, so whatever it is that you're gonna learn, after the class, I want you to put it into practice. The Bible says something, it says, study to show thyself approved of no God, a workman that needs not to be ashamed, rightly dividing the word of truth. Meaning that if the workman needs not to be, if he doesn't want to be ashamed, he should learn to study. You get what I'm saying? He should learn to study, put the knowledge that he or she has gotten into practice. Alright, so back to our class for today. Our class for today is liquidity. So first of all, what is liquidity? Liquidity is money. It's simple as that. I don't want to trying to be forming putting names and grammars to it. No, liquidity is money. That's basically what liquidity is. Liquidity is what pushes price. It's what pushes the market, right? So we're going to be talking about types of liquidity and forms of liquidity. So types of liquidity, we have external liquidity and internal liquidity. Those are the two types of liquidity we have. Why the two of them can be broken down into forms. Inside forms of liquidity, we have trendline liquidity, we have consolidated liquidity, we have one candle liquidity, sectional liquidity, and so on and so forth. Alright, so quickly now, let's just dive into it. Alright, so types of liquidity, we have internal liquidity and external liquidity. Alright, so basically I told you before that price moves in circles. Meaning price moves from internal ridge liquidity to external ridge liquidity. So this is where we are going to be starting from. Alright, so I just want to use this opportunity to explain the types of liquidity, and then we talk on the forms of liquidity. Okay, alright, so look at this. Price gave us a sweep of liquidity right here. A sweep of liquidity. You know, when we are talking about ranges, we say that a range starts from a sweep of liquidity and then give us a break of structure. A sweep of liquidity and a break of structure. Here now becomes our point A, our point B. Alright, so price creates internal ridge liquidity. Create external, price comes back to take out the internal ridge liquidity again. Alright, so look at this now. Look at this. When price created a sweep of liquidity in a bullish trend now. In a bullish trend, let's say this is an higher time frame key level that we're expecting price to come, and then price came into the key level, sweep liquidity and broke structure. Your internal ridge liquidity happens after a break of structure. And then your external ridge liquidity happens after internal ridge liquidity has been formed. You get what I'm saying? Happens after it has been formed. Although we can also It can also happen after or before. Are you getting what I'm saying? Depending on the type of liquidity that is presenting itself. Alright, so like this, price move from internal to external range liquidity. Internal liquidity to external range liquidity. Let's break this down for an example. Price swap liquidity broke structure. After a break of structure, price creates internal range liquidity. Price creates internal range liquidity, and then price goes up, break structure again, and then create external range liquidity. External range liquidity. So what we are basically waiting for price to do is for price to just come back, take out the internal range liquidity, and then we expand. Let's say this is the key level that price is reacting from. Then we expand. One thing you should know that after external range liquidity is taken, we expect price to retrace, and after internal range liquidity is taken, we expect price to expand. That's just how price moves. Price moves in cycle. It takes internal liquidity and then take out external. Then after taking out external, it comes back to take out internal liquidity and then take out external again. That's just how price moved. So price strip liquidity broke structure. This becomes our point A. Our point A pushes price to break structure. After the break of structure, this becomes our point B. And I say something that point C will always happen after a break of structure. And this is our point C. This is our point C. And we expect point C to be taken. Price comes, take out internal liquidity, and then we expect to take out external. So that's how price move from internal range liquidity to external range liquidity. And now look at this. This now like in an advanced structure. You get what I'm saying? Alright, so after external range liquidity is taken, we expect price to come back to take out internal. Now I want to say something. Look at this. Basically, we have two key levels here because look at something. I said that a range happens from a sweep of liquidity. What can you see here? Price swept liquidity and broke structure. That's a new range, meaning that inside of this place is where our key level is. There's two key level here. This particular V-shaped key level that was disrespected 2 times, and this apex key level that is standing here. Alright, so if price fails to create liquidity before coming to this key level, we expect this particular key level, this one, to be the liquidity, meaning that we expect this particular key level to go and price will use this one to expand. So you can see price do something like, let's say price is coming and it fails to engineers its own liquidity. We expect price to use this key level as liquidity, meaning that price can just do something like this and then come back to take it, then react from this particular key level, then expand again. You get me? So meaning that still the same logic, internal liquidity has been taken, price will expand. Internal range liquidity has been taken, then price will expand to take out external. Then this will now be our key level where price is coming from. Alright, so that is how price moves. That's how liquidity, internal and external range liquidity works. That's how it works. Alright, so we're going to be talking about types of liquidity, and then I'll be showing you how forms of liquidity is linked to types of liquidity. Because see, types of liquidity, we only have 2 types. You get what I'm saying? Every other types of forms of liquidity falls under the 2 of them. Alright, so you are going to see what we're saying now. So look at this. Forms of liquidity. I said we have trend line liquidity. Trend line liquidity. Let me remove this thing. First of all, it's trend line liquidity. What's trend line liquidity? Trend line liquidity is basically when price is creating, let's say in an uptrend, price is creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher highs, higher lows. Meaning that all this low that price is creating here, price is accumulating liquidity. Price is accumulating liquidity with these lows. Price is creating a trend-like manner. Price is moving in a trend-like manner, and all these lows, price is accumulating liquidity, meaning that, let me draw a good trend. This one is not okay. Let me draw a good trend that I can use to explain. Low, break, another low, higher high, another higher low, another higher high, another higher low, another higher high, another higher low, another higher high. So this low is a trend line liquidity. Why is it a trend line liquidity? Because it's a trend. You know, people that trade trend line, amazing system actually. People that trade trend line, they showed us something that look at this. So price is creating liquidity below for an uptrend now. Price is creating liquidity below this trend line, meaning that if price happens to break below this trend line, let's say price break below this trend line, price comes like this, internal range liquidity, and then price triggers from a key level here. We are expecting this particular trend line to go. We're expecting this particular trend line to go. Look at this, because this trend line is all liquidity and it will serve as magnet. This low is going to serve as magnet that will drag price, all right, meaning that when price is coming, it's going to sweep this whole low. It's going to take out everything on this low. Look at this. All right, so let's say there's an higher time frame key level here that we are waiting to sell from, and price is approaching the key level in a trend-like manner. Prices are coming trending in a trend-like manner, and then price comes into the key level. Look at what price did now. Price gave us a sweep of liquidity, a break of structure, internal range liquidity. Price came back, swept internal range liquidity, and triggered from a key level. Meaning that internal range liquidity has been taken, price will expand to take out external. Although this is our external range liquidity on the lower time frame, but when we are looking at the time frame we are coming from, and the higher time frame external range liquidity is this one. Because this particular trend, price is going to drag price. Price is going to, there are a lot of orders on this particular trend line, so price is definitely going to sweep, drag, remove all the liquidity, and then price will expand. We already, you know how a sweep of liquidity and a break of structure is used to identify a change of trend. Sweep of liquidity and a break of structure is used to identify a change of trend. So price came into the key level, swept liquidity and break structure, meaning that okay, this particular key level, price is now respecting it. So we expect price to just create internal range liquidity and internal range liquidity to be taken. And I said something. I said when price wants to create internal range liquidity is created after a break of structure. Price will first of all break structure. After breaking structure, then price creates internal range liquidity, comes back to take out internal range liquidity to take out external range liquidity. So also you can for an uptrend, the same thing happens. This is a bullish key level from an higher time frame that we're expected to buy from, and then price is coming close to that key level in a trend-like manner. It's trending downward, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. This top, at the top of this trend line, and the top of this trend is liquidity. There's liquidity being accumulated at the top of this trend, meaning that if price comes into this key level and it gives us a change of trend, this will be our target. We're expecting this whole trade line liquidity to be taken, which will serve as external range liquidity for us, because internal has been taken, external also needs to be taken. Let's see if we can see chart example. Let me flip this thing back. We can see chart examples. Alright, so cannot see a key level that this thing is reacting from, but I want to use this. now. Look at this now. So price is coming. There's an higher time frame key level here, that we're expecting price to buy from, and then price is coming, creating a trend like a bearish trend. Higher lows, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower high, lower low, lower high, and another lower low. And what did price do? Price broke, and when price broke, price creates internal range liquidity. Another high, price comes back to take out the internal range liquidity and expanded. Where will be our target? Our target will be this trend line high, this particular trend line high, meaning that price will sweep the high of that trend line. Price is definitely going to sweep the high of that trend line. Let me see if I can move this thing outside. It's not perfect actually, but let's just go with it. Let's go with it. All right, so you can see, if you want to arrange it very well, let me see if I can arrange it. All right, so it's not really perfect. You don't expect it to be perfect. You're not the one that holds the market. All right, so this is a trend line. Price is creating lower lows, lower highs, 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 lower lows, lower highs. Then price coming into a key level, swept liquidity from this low, and then broke structure, meaning that indicating trend change. Now price created internal range liquidity, and what the price come back to sweep the internal range liquidity. Where will be our target? Our target will be this trend line high, meaning that we're expecting this particular high to go. All these highs on this trend line will serve as a magnet that will drag price above. Will serve as a magnet that will drag price. And draw it down like this if you want. So the people that trade trend line, they call it a trend line break. After the trend line break, then they use it. You get what I'm saying, right? Alright, so that's how it works. That's how trend line liquidity works. I'm paying attention to the length of this video. I don't want it to be too long. Alright, so that's how trend line liquidity works. Let me look for another example. Looking at this. Okay, let me look at this. Looking at another example. Look at this one also. And look from here. What happened here? Price sweep liquidity. New range has been formed. Broke structure. Nice, amazing. Now external break of structure. And what the price did? Price was approaching this key level. Price was approaching this particular key level with a trend like form, with a trend like manner. Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And what the price did after the break of structure, a sweep and a break of structure, price engineered liquidity, and then price moved. Where was the target? Our target would be this trend line high. What the price? The price swept the high. Price took at the high because liquidity is always going to serve as a magnet that will drag price. Alright, so back to what we are saying. So that's for trend line liquidity. And then we also have another forms of liquidity called the inducement liquidity. So the inducement liquidity is one of the best that I use for entries personally. Alright, so let's see. Look at this. Don't forget to always start from a range. Whatever you want, we always start from a range. A sweep of liquidity and a break of structure. Range has been confirmed. Our bullish range has been confirmed. Sweep. Now I want to show you a difference between an inducement and engineered liquidity. They are two different things, even though they look alike, but they are two different things. Alright, so look at this. This was an inducement. Price, okay, after a break of structure, we expect price to reverse. We expect price to reverse after a break of structure, create internal rigid liquidity, or call it create inducement. And now an inducement, after an inducement has been formed, a valid inducement should take out this previous high. A valid inducement should take out this previous high before coming back to, it's either taking out this previous high, or it should move at least 50% of this particular bearish move that came down. This particular bearish move that came down, the inducement should go at least 50% before coming back to entry, before coming back to sweep it, meaning that it can either move to this particular zone before coming back to sweep it, or take out the high. In fact, I even prefer the one that takes out the high when you are talking about inducement, that takes out the high and then price comes back, react from a key level and then expand. What I'm saying is this: price broke structure. After a break of structure, price creates an inducement. The inducement should at least take out this high, should at least take out this previous high before coming back to take out this low and then react from a key level. But if you are looking at it, it's still the same thing. Look at this. Price broke structure, create internal rigid liquidity. Broke structure again, come back, sweep internal rigid liquidity. We expect external to go. So this is your inducement. This particular low is your inducement. If we go into the chart, you are going to see, let me show you chart example. Let me see if I can see anyone from here. Let me see those entries. Now look at this. This is what I'm saying. Look at this. After this break of structure, price reversed, created inducement. This is your inducement. And what did the inducement do? The inducement came to take out this particular high. Before coming to take out the low, to take out the internal rigid liquidity. And then price just reacted from this particular plug and play level. And what did price just do? Price expanded. Expanded like crazily. It expanded like crazily. So let's see, for an example, in a scenario where there is no liquidity, this particular key level will be the liquidity. But because there is a liquidity for price to take, then we look for the key level that's close to the liquidity. And what do we have? We have this particular A-shape level, and the price just expanded. So you are supposed to be buying from here, where will your stop loss be? Your stop loss will just be below this low, below this candle low, below it a little, yes. And then where is your target? Don't forget that this is also a trend line. External rigid liquidity will be your target. This is like a 1:15. This is basically how I trade. Are you getting me? This is how I trade. I won't teach you what I don't do. It's what I do. That's what I'm teaching you. That's it. This is what I do. Alright, so that's what inducement is. I only have like 7 minutes to finish this session. That's what inducement is. Now look at the difference between inducement and engineered liquidity. Look at the difference between inducement and engineered liquidity. Let's remove this part again. Alright, so I said that inducement should at least take out this previous high. Before coming to take out the low. But for engineered liquidity, which is our forms of liquidity number 3, for engineered liquidity, price can just come close like this and then sweep it again. The logic is this. Look at this. The logic is this: price swept, broke structure, coming down. There is no liquidity here. So price has to engineer his own liquidity. So engineering his own liquidity to trick people to buying from here. A lot of people will be buying from here. And when they are buying from here, what price you do? Because price needs liquidity to move. There are a lot of orders that price needs to take, and in an attempt to take it, he has to take liquidity. You get what I'm saying? People have to lose money. So price reacts from here, deceive early buyers. So when they start buying, they start jumping into the buy, price comes back to sweep the low. Engineers liquidity, sweep it, tap into a key level, and then they come to take out the high again. Just like that. That's how engineered liquidity is. And it's like, I have an example here. This particular trade, where is it? Yeah, this is it. Looking at this now, price swept a low, broke structure. And what did price do? Price came, created this low before creating this one. Created this low and then went up. Deceive like this, like a trap, an engineered liquidity. Price created this low, went up, and then came back again to sweep the low. Came back to sweep the low. Sweeping the low, price tap into a key level from here. This particular plug and play, price tap into it. And what the price just expanded to take out the external reach. Oh, this is it, right? Price take out the external reach liquidity. If you go to the 30 minutes time frame, let me see it so that it will be clear. See what I'm saying? Now, can you see it now? Price came very close to this key level and then started going down. A lot of people will be jumping in from say, I don't want to miss this trade. Price give them an engulfing here. So a lot of people will be jumping into it. Hey, I don't want to miss this trade. What the price just do? Price just came back, swept that low, tap into a key level and then expand. Price just expand like that. That's how it is. Price just expand. Alright, so the same thing happens for a bullish scenario. The same thing still happen. Yeah. Price broke sweep of liquidity, broke structure, new range confirm. Then price engineers his liquidity very close to this key level, and the price come back to sweep the liquidity and they just expand to take out external from here. External was taken. Alright, so which number are we? Number 3, maybe number 4. Number 4, consolidating liquidity. Consolidating liquidity. Alright, so look at this. Let me explain something now. We talked a little about this particular key, this particular one when we were doing our basic market structure. We talked a little about it. So let's say price is in an uptrend. Basic market structure, higher highs, higher lows, higher highs and higher lows. Alright, so then price does something like this. Price came down very close to this key level and then started consolidating. Creating liquidity on both buy side liquidity and sell side liquidity. Buy side liquidity and sell side liquidity. Your own is just to understand the logic, understand the aim, and you won't fall victim of it. Understand the aim of this thing and you will not fall victim of it. Look at this. So price is trying to accumulate liquidity on buy side and sell side. Alright, so let's look at this. So price comes close to a key level and then started going kickstart from here. A lot of people will be buying from here. Let's jump into the buy. They'll be buying from here, and then this first push, a lot of people will be selling from here. Let's sell from. If you go on a lower time frame, you're gonna see it like a trend line manner. It's gonna be like a trend. So a lot of people will be selling from here. A lot of people will be buying from here. So price will just be accumulating on both sides. The aim is just to what price will do. If price is bearish, price can take out this particular low. Taking out this low, it will take out all the buyers, then comes back to take out all the sellers before going in its intended direction. So for a scenario like this, price can just wick above all the sellers, take out their stop losses, and then comes down to take out all the early buyers, tap between key level and expand. Same logic. Internal range liquidity, external range liquidity needs to be taken. Your own is first of all to understand your range. Once you understand your range, you won't fall. We know that everything that is going to be happening here is just a trap. You are expecting, as far as price does not go below this low, you are still bullish. Are you getting what I'm saying? So also for a bearish scenario, as far as price does not go below this high, you are still bearish. So all this thing that is happening is just a trap. All right, let me see if I can see chart example for this. I don't think so. I don't think so that I can see. Is that, I don't know. I do not know. The next one is gonna be single candle liquidity. Single candle acting as liquidity. Single candle liquidity. I can't find any. I don't know. My chart is refusing to show. My chart is refusing to show. Sorry, guys. So I can't find any. If I find, when we are talking on the key levels, I'm gonna show it to you if I happen to find. All right, so let's go to the last one. Let's go to the last one. The last one is single candle liquidity. Single candle liquidity. That is an amazing one. This one most likely, it works on all time frame. Actually, you can use it on all time frame. Let me know, see if I'll use it. Open the eyes of my, I want to see you. I want to see you high and lifted up, shining in the light of your glory. Hold out your power and love, wishing holy, 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 high and lifted up. Sorry guys, I'm trying to drone this thing. Shining in the light of your glory. Hold out your power. I want to see. Alright, so a new range. Sweep of liquidity and a break of structure. Sweep of liquidity and a break of structure. Now, for this, look at this. This is the break of structure, right? Now, this is where single candle liquidity comes in. This particular candle that broke this structure. Alright, so good. So this candle that broke structure. So price broke structure with a full body candle with an impulsive move. Price moved and broke structure. Then the candle closed above. Sorry. The candle closed above it. I'm trying to behave like this. Let me use another separate. Let me use another key. break of structure, right? No, this is our this is another time frame key level. This is a key level that we want to buy from. We're interested in looking for buys. So then price coming into the key level, price broke structure with a single candle. This price broke structure with a single candle with an impulsive move and close above it. Now this becomes the weak of the candle that broke structure. How this one work is this, look. It actually works in two ways. There are two ways we use single candle liquidity. When we are talking about storyline, we are going to talk about the other one, but we are just going to be focusing on one. If you watch my video on confirmation entry, you are going to see it. I talked about it. In fact, it was the confirmation. I talked about two confirmation entry, the engulfing and the single candle liquidity. All right, so back to what I'm saying. So this particular price, then the next candle then comes like this. Maybe created a high like this, created a high and a low. What single candle liquidity means is this, that this particular candle in between, that is inside of this bullish candle that broke structure, has the ability to serve as internal range liquidity and external range liquidity. This candle that is in between this bullish candle that broke structure with an impulsive move has the ability to serve as internal and external range liquidity, meaning that, let's say this a key level is below like this, meaning that what we are expecting price to do is that we're expecting price to come, take out this candle low, and then expand to take out this candle high. That's what it means. A single candle acting as internal and external range liquidity. If you inverse it, it's still the same thing. After a sweep and a break of structure, a new range is confirmed, direction is confirmed, then price broke structure with a full body candle, and then the next candle closed like this inside of this bullish candle. This particular candle has the ability to serve as internal and external range liquidity, meaning that if the internal range liquidity is taken, price will expand to take out external. The same logic, the same system. We are not changing anything. All right, so let me see if I can find an example. Let me go to the 4 hours time frame and then we'll be done. 4 hours time frame and then we're done. Right, I'm looking for a good example. I need to change this thing back to the way it is so that I can see where, because I'm not seeing where. To see you high and lifted up. Should I use Euro? Let me use Euro USD. It's like I have one there. Yeah, this particular one is it. Yeah. Shining in the light of your glory. Now look at this. Price coming into an higher time frame key level. First of all, sweep of liquidity and a break of structure. Story now, direction is now confirmed. Now look at this. Price closed above it with a full body candle. This was the high of the candle. You can see this next candle was inside of this bullish candle that broke structure. This next candle was inside of this one. Oh, you are not getting me. This next candle, this particular candle was inside of this bullish one that broke structure. It was inside of this bullish one that broke structure. And we said that this candle has the ability to serve as internal range liquidity and external range liquidity, meaning that if price comes to take out this low, we expect price to take out this particular high, serving internal and external. That's what we expect. This video is already too long. I want to stop it here. Let's say this is the key level that price reacted from. there's a key level there on the lower time frame, maybe 2 hours time frame, that price reacted from. If we are buying from here, this high needs to go. In as much as we know that there's a trend line liquidity up here that needs to go, but when we are paying attention to internal, external on the lower time frame, this high will be the one to go. All right, so that's just the same logic, the same thing. All right, so your job now is to go and practice it. This video is already long. All right, so see you in the next video. Be talking about key levels on the next one, how to navigate key level, how to know a valid key level and invalid key level, and types of liquidity, types of key level. So see you in my next video. Have a nice day.